Hey, it's Rav. Welcome to Everyday Investor, the hottest investment show in the world. That's right. I said it. I don't care who knows it. This show is designed to help us grow our money for a purpose. And that purpose is so that we can spend more time with family, friends, engaging in a purpose meaning that's greater than ourselves. The challenge often is we take our precious time, we go to work to get money in order to eat. We take our time, we go to work so that we can get a paycheck to be able to provide. But imagine a world where money could make you money, so you have the option to work a little less and therefore engage in the things that matter most to you. Like I said, family, friends, meaning, all that kind of good stuff. I am super excited about today's show. You want to know what it's about? Wait for it. We'll be right back. Coming up, Rae Ostrander teaches us how best to invest during COVID.
I was renting because it was less expensive to rent, and the equity that I would have required to buy, I could be making 20, 30, 40% returns on that money in these types of investments.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey, it's Rav. Welcome back. We're talking to my good friend Rae Ostrander. We've got a special surprise for you. Before we talk to Rae, let's find out what's happening in the world of stocks with Omar Khan. Omar?
Thanks, Rav. Omar Khan here, guys, with Theta Trading again. Just want to give you a recap of what happened in the markets this week. Weird week. We had all kinds of stuff from GameStop and BlackBerry and AMC Movie Corp. All these old companies that were thought for dead all went through the roof. Why? Well, what happened was a bunch of people on Reddit essentially said, hey, there's a huge amount of short sellers in these stocks. What we're going to do is we're going to coordinate an attack against them, and we're going to buy these shares, then thus sending the shares of these companies that don't really make all that much money, or any money, in fact, to astronomical levels. So basically what they did is they coordinated attack on these hedge funds that had short positions and wound up making billions of dollars for themselves. That was one part of the market this week. The other part of the market this week was very good earnings from Facebook, from Apple, from Microsoft, from Tesla. So that's what the market rewards in the long run, high quality earnings. And that's what we had last week. So hopefully we see more of the same going forward. And the markets do very well this year, but we'll see what happens. Anyways, back to you, Rav, and we'll see you guys next week.
Thanks, Omar. Always great to hear from you. Rae Ostrander, my brother, thank you so much for being on the show. I know that you've been busy doing your own types of investments, but when I can get you, it's always a pleasure. Thank you, Rae.
I'm happy to be here. I don't mean to be that reluctant guest. I just sometimes feel like a bit of a wet blanket with some of my commentary. So.
And what do you mean by that? And that's why I love you. I think I know what you mean. What does that mean, wet blanket?
I think everyone's excited about getting involved in real estate. And there's a buzz about that. The markets are going up. There's probably never been more training out there that you can take and people who can offer advice. And I think that that's an exciting place to be. And I'm sitting on the sidelines going, I think there's a bit more of a careful posture we ought to take in this environment. And so, my mom told me, if you can't say something nice, don't say anything at all. So I kind of feel like, why don't I need to tell somebody that what they're doing is a little more risky than what I would do, or I don't really think that's going to work real well, or it just feels a little negative, and I hate to be that guy,
Well, promise me something that you'll be candid during this very short time we have with Rav and all the viewers and those that are listening via podcast. Because Rae, you have so much. I mean, you just mentioned training. I mean, you're the master trainer. You've been doing it forever. You would teach on Robert Kiyosaki stages. You would teach on Keyspire stage, all over the place. You would, you were even teaching spirituality on stage for a while and all that kind of stuff. And then you stopped about a couple of years ago. You stopped training, coaching, teaching Of course, I get you in my backyard and pick your brain all the time, so thank you. But you stopped doing that and you just continue to stay in your lane, continuing to invest for you, your family, and your friends. Why did you stop training?
I think there's a few reasons why. I mean, I really like the organizations that I had a chance to work with. I love their intentions and what they're doing. I think it just got to the point where, with prices going where they were across the country in Canada, it became more and more challenging for me to talk about the idea of investing for cash flow, which has always been my priority. So it just became a little disingenuous if I were to continue doing that when really there's not a lot of cash flow to be had. And we can do some calculations. So I think that's sort of one thing. But the other thing is I really had an opportunity to step away and work more people like yourself. And we have sort of a close group of friends that we kind of know. And working and training with those individuals and also benefiting myself from that interaction, that's been really fulfilling for me. So it's not that I don't love doing the training. I miss it. I thoroughly enjoy getting up there and doing it. But the challenge I think that exists is sometimes people also don't want to hear this. And I'm just not overly interested in kind of twisting people's arms into doing something they don't want to do. And there's a few different things that I know you've asked me to talk about coming up at a training. So hopefully people will enjoy that. They'll probably feel a little challenged by it, but I'm happy to share.
Well, you just gave it away. I didn't give it away yet, and you just did. I am so excited for you that are watching at home or listening via podcast. Rae has been out of the training, coaching, teaching business to the masses. He's been still doing it, and I've been a grateful recipient of that. But I have Rae Ostrander, March 6th. Put it in your calendar. First time ever in 17 years, Everyday Investor is hosting a workshop. It's March 6th, 10 a.m. to 4 p.m., and it costs a lot. It costs you to be able to pay something forward to somebody else, whether it's a non-for-profit, charity, all that kind of good stuff. This event, dollars-wise, is free. Rae, thank you so much for doing that. March 6th, 10 a.m. It's a Saturday, and you're going to go for about 6 hours, you said, right? You're going to go from about 10 to 4. And, Rae, I'm really, really grateful. There's a lot of people out there, especially during the last 9-10 months in COVID, that are wrestling, whether it's anxiety, yours truly, whether it's depression, whether it's just feeling isolated, whether it's, losing work, and my heart breaks. At the same time, there's a lot of people out there that don't know where to invest during COVID. You've been steady. You've been continuing to invest in cash flowing properties. And so I'm very grateful that you're going to take an opportunity, take a whole day actually, and teach people what you love about real estate investing and the specific projects that, or types of investments rather, because, there's no upsell here. We're just doing this to be able to give back. So thank you, Rae, for doing that. You mentioned a word, cash flow. What is that? What does cash flow mean? I try to make this show savvy. Even I want the high school seniors to be savvy when it comes to investing, and they might not even know what that means. What does cash flow mean as opposed to whatever else?
Yeah, that's a really important question. We talk about definitions, and there's obviously a scale when we talk about cash flow. Some people are talking about cash flow today, and it's very different than what I generally talk about. So we'll get into a lot of detail over the course of the training session we'll do. But just for a simple example, I pulled up a couple of numbers on a property that we purchased about 4 years ago, and just some basic numbers you can throw down here. So I purchased the property for $3.6 million.
Okay.
The income on the property is $516,000.
$516K annual is the income on this property?
Yep. Now the expenses were around $248,000. That was the annual expenses. So if we put that down for the annual expenses, $248,000. Again, we'll get into more detail on this later, but you'll notice that that's just under 50% of the income. I mean, you typically want to be in that range where your expenses, you're looking at something that could be even 55, 60% of income, depending on the capital expenditures that you're planning to budget for. But that's a reasonably good range. and that's what we expected at the time. If you subtract the income, you take the income, subtract the expenses, you get the NOI. And the NOI in this case is $268,000.
NOI means what?
Net operating income.
Okay, so 268, you said?
268. Now, the reason why I provided that particular information is just to look at cap rate. We're not going to talk too much about it, but it helps us to compare apples to apples. So when you're calculating cap rate, you just take the NOI and divide it by your purchase price or the value of the asset. So in this case, I'll give you that number. The cap rate on this property was 7.4%.
So I'm taking the 268 and I'm dividing it by 3.6 million. And so then that equals what?
It's 7.4%.
7.4% cap rate. And so we're going to get into a lot of this kind of stuff in your training. But what you really enjoy is somebody is making $250,000 to $300,000. That's cash flow. If we have a few of these,
not quite. One more step. Is this does not include the debt service, because this just talks about the asset and how it performs. When we want to look at, maybe you want to put down 50%, maybe someone else wants to put down 20%. So let's assume that we put 20% down on this. If we put 20% down, we end up with a debt service cost, mortgage payments of $151,000. So let's put $151,000.
So 150, and this is your mortgage payment?
That's correct.
For the year?
For the year. So our cash flow would be to take the NOI, subtract the debt service payment, and that's what we end up with. And that number in this case is $117,000. Now that'll be off by 1,000 just because the debt service was 151, not 150, but it's close enough.
Yeah.
So we get $117,000 of cash flow.
With 20% down.
With 20% down.
With 20% down. Yeah.
What that is, if you take the 117 and you divide it by what was required as a down payment, it gives you your cash on cash return. So let's put that down as well. The cash on cash return in this situation was 16.25%.
Got it.
Okay.
So that's the special number. Basically, you're saying if somebody wants to know what's the ROI, you're saying cash on cash, I'm making over 16% and I'm making six figures, $100,000, over $100,000 if I put 20% down cash flow.
Correct. But that's what we did 4 years ago. I've just sold that asset and I'd like to show you what it is today. Can we do that right next to it?
Let me get rid of it. It's okay. People can take a screenshot of this.
Perfect.
Okay. So you bought it for 3.6. All right.
About 4 years ago. And then we sold it just actually about a month and a half ago. And we sold it for 5.9.
That's not a small number.
No, it's great. And my purpose in this is to show the cash flow differential. So we can come back to me bragging about it in a minute. But if you look at the cash flow, the income did go up. The income on this annual income was $572,000. The expenses rose a little bit as well to $282,000.
Okay, 282.
Which means our net operating income again now is $290,000.
290. And when you say net operating income, we're not talking about if there's a mortgage on that.
That's correct. But let's stop here and do the calculation of the cap rate, because that's how we evaluate the asset. The cap rate in this case is 290 divided by now 5.9 million. So that brings us to a cap rate of 4.9%.
Yeah, 4.9%. Now people are watching and they're going to say, but Ray, wasn't the 7 point whatever better than the 4.9? And that's where on March 6th, you're going to be able to teach, no, of course, when you're selling a property, the lower the cap rate, the better. And these are the kind of things that, I look forward to you being able to teach. Ray, hold those thoughts. We're going to take a quick break. We'll be right back. We're talking to my good friend, Rae Ostrander. He's going to be teaching March 6th, Saturday, 10 to 4 Everyday Investors' very first workshop. We still got a lot more to hear. Don't go anywhere. We'll be right back.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey, it's Rav. Welcome back to Everyday Investor. Super excited to have Rae Ostrander on the show. He is a coach, teacher, trainer, and investor. Very, very excited that he's going to be teaching the very first Everyday Investor workshop, March 6th, 10 a.m. You can go to everydayinvestor.com to register. This is a free event, but I do ask you to pay something forward in any way that you want, whether it's a benevolent act, non-for-profit charity, all that kind of good stuff. Help a neighbor out. Before we get back to Rae, we're going to go to our mortgage expert, Kyle Ford. Over to you, Kyle.
Last week, we talked about how we can put less than 20% down on our primary residence. This week, I want to talk about how we can be strategic in the type of property we buy as our primary residence. Did you know that if you're buying a single family or duplex, you can put 5% down? If you're buying a triplex or fourplex to occupy as your primary residence, you can put as little as 10% down. This is one of the great house hacking strategies that a lot of newer investors are using. They buy a triplex, live in one unit, rent out the other two. Ideally, the other two units are covering the bulk of the property's expenses, and you're living close to free. This allows you to quickly save another down payment, so you can either put 20% down on a new property or refinance the existing property later and put that 20% down on a new primary residence. This is something that I did as one of my first investments. It allowed me to save that down payment incredibly fast, and I still own this property today. Thanks, and back to you, Rav.
Kyle, always great to hear from you. We will talk to you next week. Rae, thanks again for being on the show, my friend.
Of course, of course. Where did we leave off? Cap rate?
We left off with talking about, well, you were showing us the importance of cap rate, and I think a lot of viewers don't necessarily even understand what that is. I know it takes time to explain, and you'll do that March 6th, but give me a little bit of an explanation, if you will. What is a cap rate? What's the purpose?
The cap rate is really designed to be able to tell you how long it takes to capitalize a project. So if, for instance, you have $1 million project, that's what it costs to buy the property. If you have a $50,000 net income every year, it will take you 20 years of $50,000 to get to that $1 million mark, to capitalize it. That would be considered a 5% cap rate. So What's the point of the cap rate? It helps us to compare apples to apples in different products.
What else can we expect March 6th?
You got to go through active investing, how to calculate, how to evaluate an investment, and then looking at how can we finance that investment? How do we manage it? What's the right structure? Should we hold it personally or corporately? There's not always a right answer, but we'll talk with people about their specific situations and give some examples. In addition to active, we got to talk about passive, lending, development, things that all of us are doing in different areas. How do you diversify your portfolio? And I think another really important area that we want to touch on is how can people begin to use their RRSPs, TFSAs, with stock trading, options, mortgages. There's lots of things we can do in there when we self-direct our RRSPs. So we'll talk about that as well.
Hey, you got to take it easy on me, dude. It's only a one-day event. I don't have as much as I like to spend a month with Rae. No, I'm really grateful. You're going to be able to hit on all these kind of things. Are we done with this exam?
One more thing here, real quick. One more thing on this one. So the cap rate here was what? 4.9%, right?
Yep.
4.9%. Now, cash flow. We have to talk about cash flow here. That's what we want to finish out. The debt service in this case, again, when we go 20% down on a $5.9 million purchase price, we end up with a debt service cost of $249,000.
$249.
Yeah, so you take the $290 and you subtract $249, and that gives us our cash flow, which is $41,000.
Okay, 41K cash flow.
41K divided by your 20% down gives us 3.5% cash on cash return. So for those people that were paying attention and took some notes, it was comparing 16.5% cash on cash return to 3.5% cash on cash return. What's my point? If we're investing today, people are buying properties at a 4.9% cap rate today in places like Sarnia, even lower than that in places like Windsor. Is that the right move? For me, when I'm buying it with a cap rate of 7.4%, we're getting a 16% return. There's a difference. That's all I want to make sure we talk about at this training is there a right time to sell? I think there is. Is there a right time to buy? And then where can we shift our attention in terms of our investment strategy? So that's just one example of cash flow isn't the same as cash flow. You have to break it down and understand what's your risk here? How much margin do you have?
What I hear you saying is this is a time to continue to invest, but make sure that we're calculating cash on cash returns. It might not be in the areas that we think we're supposed to be in.
Yes, and we do want to consider appreciation, but we want to understand appreciation is more speculative. And if that's all we're going for, that significantly increases our risk and it changes the type of investing that we're doing. So we just want to really get honest with ourselves about what we want. And if we need to change geographical locations, if we need to change strategies and investment vehicles, maybe we look at different options. That's my intention.
Yeah. So you're saying that for Rae, he wants money coming in monthly to be able to feed his family. If the investment vehicle goes up in value, that's gravy. Obviously, we want it to go up in value, but if for 20 years it stays at the same price, but it's been feeding your family, that's the whole point. Ever since I've known you, you've always been big on cash flow if you want to be an investor. And I know if there's anybody that I want to go to when it comes to making income from their investments, it's you. You've been doing it for decades.
Yes. The point is, why do we do what we do? That's an important thing to ask ourselves the question, what are we looking for? And if we buy a house, I think for most people, we just have to recognize we buy a house because we want a place for our family. Maybe it's a family estate. We had a farm in our family for 100 years. But at the end of the day, the thing I think I do a little bit differently than most people, and why it's a bit annoying, is I really press people on, why are you really doing this? Don't tell me it's because you think it's a good financial investment. If you just want it, no problem. Go make the investment that can pay for your lifestyle. We don't need to judge each other for what kind of car we buy or what kind of house we have. But let's not call it a great investment just to justify spending the money on it. That's my major point. So with the rent versus own, we won't get into all the details, but really it's just to help people realize that what's stopping us most of the time is the way that we think about investing. Here's why. My father in 1980, right around 1980, bought a single family house that we lived in Malton, Ontario, right by the airport, for approximately $75,000. Could you write that part down? $75,000. That was the cost of the house. Now, at that time, he was making about 65 grand a year as middle management, doing his thing, working his way up. And my point is, at that stage, it was absolutely a great investment to buy a house. We see the differential. But on the other hand, today, that house is worth about $700,000. That was what it would cost to buy it today. Let's throw that up there, $700,000.
Okay.
Now, if to the right, you can put, just to the right of that, you can put 65,000 income, just to the right of 1980. 65,000 income. What's the primary breadwinner in middle management making today? I mean, you pick the number. Is it 80? Is it 85? Say it's 100. Put 100 to the right there. My major point that I want to make with people is when the environment changes and when it changes radically, we can't continue to do the things that we've always done. In the past 5 to 10 years, our environment has changed dramatically. So we need to pay attention to that. This is more of an obvious example. If
Yeah.
someone was making 65 grand and they could afford to buy a $775,000 house, beautiful. If someone's making 100 grand and now they're buying a $700,000 house, doesn't it seem like that is actually costing a lot more of their disposable income?
Yeah.
So can they afford it? That's my question. And we've always been taught, don't buy things that we can't afford. This is a perfect example of something I don't think people can afford. So why are we doing it? Renting might be an option. I'm not saying it is, and we'll go through all the details. My point to people is we have to pay attention that if income only goes up 30% and the value of property goes up 1,000%, literally, we need to recognize there's a change. Let's change our approach. So there's things like that that we want to talk about on March 6th. How do we adjust to what's happening in the changes and manage the risk?
Well, I mean, Ray, I think this is not hypothetical. Everybody who's been watching my show knows my situation. I rented for years because I was investing. But let's talk about you for a second. You, have how many doors or tenants or customers would you say? How many do you have right now?
We've sold a lot in Canada. We've got our US holdings now. We've got over 700 units at this point, and we're just about to close on another 500. So it's over 1,000.
Okay, so you have, but let's before you're just about to close.
Yep.
You are making cash flow from 700 individuals.
Correct.
And correct. So you believe in buying real estate.
Yes, I do.
Yes. You just recently, because you wanted more space, you wanted the lake, you wanted to be able to go in the woods with your ATV, you wanted to do that for your beautiful girls.
Why are you making me sound like a redneck?
So you bought your house 20 years ago, 10 years ago. When did Rae Ostrander buy the house that he's living in right now, and we're in 2021?
A few months ago.
A few months ago is when you bought your house. Prior to a few months ago, all that time, 10, 15, 20 years, you were renting.
I was renting because it was less expensive to rent, and the equity that I would have required to buy, I could be making 20, 30, 40% returns on that money in these types of investments. So it just wasn't a great return on my investment, that's all. And by the way, the house that I bought is also a horrible return on investment. It's horrible, but it's a lifestyle choice. So I can spend time with my kids on the dirt bike, and I can spend time, life is short. And like you talk about, that's why we're so well aligned in this. I believe that, life is worth living, and we only have an opportunity to do that now. So I'm fortunate that my investments that you put up there are able to pay for my lifestyle. And that's the objective, right?
Of course, I get it. And that's why I did it for so many, many years. And then, there's a walk around the lake, and I got the dog, and my kids were homeschooled here. And okay, let me pull the trigger and let's buy it. But as long as Rav understands, generally speaking, it's a depreciating product. And this is what you're going to get into March 6th, and you're going to spend the day with us. Rae, time is up here. I'll give you 30 seconds, kind of some closing thoughts about what we've been talking about and what we can expect on Saturday, March 6th.
I guess my biggest encouragement for people is don't let someone else do your thinking for you, right? Let's engage in some critical thought processes here, break this stuff down, and really think about it. Spend some time with it so you know what's best for you. Maybe mortgages are the best thing for you, investing in first mortgages. Maybe you want to do some more active real estate. There's just tons of opportunity, but we just have to spend a little bit of time to really evaluate what's best for us. I mean, that would be my biggest encouragement to people, Rav.
Love it, Rae. Can't wait to have you here in the studio in person. Thank you so much for showing up today.
Awesome. Take care, Rav.
Thank you, viewers at home, for watching. Without you, we would not have a show. So grateful to you. Make sure you tune in next week. Same place, same time. Honey, I love you. I'll be home soon. Bye, everyone.